Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Redwire space.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We're talking about a company that's, well, it's really at that high growth, high risk intersection of defense and commercial space.
Absolutely.
And when you look at the financials, you just have to start with that top line performance. The numbers that came out of Q3 2025 really caught everyone's attention.
That's the headline we all saw. Redwire reported what, $103.4 million in revenue for Q3?
That's the one.
And here's where it gets really interesting for me. That's a 50.7% jump year over year. I mean, that's huge. What drove that kind of explosion?
Well, the primary driver, without a doubt, was the successful and really rapid integration of the Edge Autonomy acquisition.
Oh, okay.
But you have to combine that immediate revenue lift with the strong, sustained demand they've been seeing across their legacy space and defense segments.
Okay, let's unpack this a little. They're growing fast, but growth, especially this kind of growth, it needs fuel.
Yeah.
What does the contractual pipeline actually look like?
It's very robust,
It's
which is crucial here. The backlog grew to $356 million.
$356 million.
And their book-to-bill ratio is strong, sitting at 1.25. Even more impressive, though, is the reported $10 billion pipeline of potential future contracts.
$10 billion.
And that's the multi-year context that investors really need to be thinking about.
That $10 billion pipeline, I mean, that suggests they have something unique. What is their strategic edge against, the giants like Northrop Grumman?
Their moat, it really comes down to proprietary IP and, frankly, very high switching costs for their clients.
Okay.
We are seeing some serious first-mover advantages in these critical space infrastructure areas.
Like what, specifically?
Specifically, think about the European Space Agency's Velio SkimSat and the NICS spacecraft docking systems. These are mission-critical components.
So once you're in, you're in. The barriers to entry for competitors are just astronomical.
Exactly. And we saw news about some major defense wins recently, too, right?
We did.
Key contracts include these major roles in the Golden Dome missile defense program, and they also secured Army long-range reconnaissance contracts.
So the Edge Autonomy synergy, that's all about integrating that autonomy tech across these different platforms.
Precisely. If you connect the dots, they're placing themselves right at the intersection of defense modernization and next-generation space tech.
Okay, so the growth numbers sound great. The pipeline sounds incredible. But we have to look at the other side of the ledger for anyone listening.
We do.
The company has significant debt, and they're not currently profitable.
And this raises the most important question. Can they translate all that revenue into actual profit? As of Q3 2025, long-term debt increased to $184.7 million.
Wow.
And on top of that, Q3 2025 saw a negative adjusted EBITDA of negative $2.6 million and a net loss of $41.2 million.
So what does this all mean for their valuation? It sounds like those losses and that negative 60.8% EBIT margin, those are the primary hurdles right now.
Those are definitely risks, no question. They're largely due to acquisition costs, some changes in accounting, what they call EAC, and crucially, government shutdown delays.
Delays that pushed work into 2026.
That's right. But the bull case here is that these are transient issues, they're temporary. Liquidity, for instance, actually improved 46.2% year over year.
To what, 89.3 million?
89.3 million, yes. And their massive contracted backlog really positions their free cash flow for a positive inflection point, especially as those edge synergies and margin expansions scale up.
Towards that 27 to 30% target.
That's the goal.
Let's switch gears a bit to the market action itself. Despite all that volatility, the stock saw a massive move in December of 2025.
That 37% rally in December, that was a huge signal. It was driven almost entirely by the Golden Dome and those Army contract announcements we mentioned.
And technically, the stock is now trading above its 50-day moving average. I know analysts are watching for a potential golden cross.
They are. That would be a very powerful technical confirmation.
And we've seen strong volume, too, up to 4.7 million shares on some of those positive days, which suggests accumulation.
Absolutely. Traders are really focused on that $8 level now. It's become a pivotal area of either support or resistance.
And you have to add in the insider activity, which adds a lot of confidence to the technical strength.
It does. The CEO, Peter Canito Jr., and others have been engaged in what's called cluster buying. They've boosted insider ownership up to 2.6%.
Which is a huge signal. It shows internal confidence in the future trajectory, even with the current losses on paper.
It's management putting their own money on the line.
So looking ahead, the next 3 months seem critical. What's the primary catalyst we should all be watching for?
It's the Q4 2025 earnings release. That's expected in early February 2026.
And the expectation there is for a revenue beat.
Right.
Right. Because of those delayed government orders finally flowing in.
Exactly. The expectation is that those delayed orders from the shutdown finally get recognized.
Plus, you have these broader macro tailwinds, defense budget boosts and maybe some sector rotation into the whole space economy.
Exactly. And when you factor in the bullish analyst forecasts, you see some significant upside. There's a $22 price target that was reiterated in late December.
$22.
So the overall thesis is pretty compelling. That $10 billion pipeline, it offers true multi-bagger potential once the profitability ramp really starts to materialize.
So the investment horizon seems kind of dual-pronged here. You have a potential swing trade targeting the Q4 earnings.
Right.
Or a much longer-term hold waiting for that full profitability ramp to take hold.
Precisely. It's a risk-reward profile. You're betting on the current high growth and a future inflection in free cash flow to overcome the current net losses.
That was a fantastic summary of the pros, the cons, and the near-term catalysts for Redwire. So what stands out to you as the single most critical factor for listeners to keep an eye on over this next quarter?
For me, it has to be the margin expansion. Can they prove that the operational streamlining is sustainable? Can they push those gross margins higher and turn that incredible revenue growth into realized free cash flow?
That's the real measure of success.
That is the measure of success we need to watch.
Great point. If you found this discussion useful, remember to subscribe and turn on notifications so you don't miss our next stock analysis. We appreciate your support.